Well, it's funny how their targets work because basically they're saying that they're not debasing your currency fast enough, and that they want to increase that rate, right? So that's something that they were doing for a number of years. And basically, what you had back then was a period of commodity oversupply. And so in North America, we ramped up shale oil production rather quickly,
Mhm.
and that was supported by low interest rates, as well as investors that were willing to keep investing into something that was free cash flow negative for the most part. And so in aggregate, that industry was not free cash flow positive. They were relying on issuing debt and equity to investors, and they for a long time they were happy to fund that. And so we had this period of oversupply, at the same time as we had slowdowns in emerging markets, especially when the dollar strengthened after QE3 ended. And so you had this period of time where demand was a little bit weaker than people expected, supply was more than people expected, and so we had commodity overabundance. And that happens in the long-term commodity cycle that we go through globally. And so that kind of hit its crescendo with negative oil prices during the COVID lockdowns. That was kind of the second washout for that space. And then when you combined the currency, the amount of currency that was created from fiscal stimulus primarily, as well as holding rates below inflation, doing a lot of QE to monetize the debt issuance associated with that fiscal spending, they basically reinflated demand at a time when a number of supply, a certain amount of supply was taken offline. And so now that we have more commodity scarcity, right, from years of underinvestment due to low prices, as well as an uptick in demand back to prior levels, this is a very different environment than what they had, over the past 5 years or so.
Mhm. So, should the Fed have maybe been in a more defensive or resilient position in 2018 and 2019 with interest rates needing to be higher than they were?
Well, they certainly tried. I mean, they were raising rates, and the famous Powell pivot. A lot of people looked at the 20% down in the S&P 500 and assumed that's why he pivoted. But I think for people that are looking at the nuance, I think it was the credit markets that led him to pivot. And so there is that period, about 6 week long period in late 2018, where no junk bonds were issued. For example, credit markets basically slammed closed on them, and that's a much more acute problem for the economy than S&P 500 going down 20%,
Mhm.
especially from rather elevated levels. And so they tried to raise rates until they basically were told by the market that we're going to freeze up and go into recession if you keep trying to raise it. And so they eventually stopped raising rates. Then they were still trying to taper their balance sheet down, and then they got the repo rate spike.
Mhm.
And so interbank lending markets broke, and basically, there are too many T bills relative to reserves in the system. There are all sorts of reasons for that. They had to start monetizing debt. They had to start taking T bills off the market, and so there were not a lot of options if you were the Fed. Now I think there were options decades ago. I think there were under Greenspan. I think there were certainly options. I think they could have had a tighter thing going into this whole environment, but after the global financial crisis, and then during that whole rate hiking cycle and balance sheet reduction cycle in 2017, 2018, and into 2019, that was basically a period where there's only so much they could do by that point. They had already kind of backed themselves into that corner.
Mhm. So, Lynn, I guess the logical place that my mind goes as hearing you explain that is, where does it all end? I mean, there's a crazy amount of debt in the system right now. Is the most likely path to just inflate it away?
I think that's the most mathematically likely path. Yes, I mean
Mhm.
basically, studies show that when countries get this indebted historically, they have like a 98% default rate. There's like a study by Hirschman Capital, I believe it was a couple years ago, and generally when you get over 130% debt to GDP, there's really no way to recover from that level without basically defaulting in some way. Now, that default can take numerous forms. If you're an emerging market and you owe dollars, you can't print dollars. And so defaults are likely to take place as actual defaults,
Mhm.
restructurings, basically saying we can't pay 100% of it. Maybe we can do half of it. Let's figure out how to, do a haircut here. Of course, the other option is if the liabilities are in a currency that you print. If you're a developed market and if you're in the United States and they're denominated in dollars, or if you're in Canada and they're denominated in Canadian dollars, then generally they default through inflation, where they don't actually default. You get paid back every unit of currency you're promised, but those are worth maybe a third less or a half less than they were maybe at the start of that decade.
Mhm.
And the only other time the United States had this much debt to GDP was during World War II, and that's exactly what they did. They held interest rates at near zero. They pegged the long end of the yield curve below 2.5%, and you had very high inflation. They even had, at one point, they had 19% year-over-year inflation, and they were holding rates at zero. And so
Mhm.
if you were holding treasuries, you lost something like 40% of your capital from the early 40s to the early 50s. And I think that that certainly could be what we're seeing going forward. I mean, pretty much ever since the global financial crisis, um, rates have been negative in real terms, right? So they've been holding rates at zero while inflation was some low positive number. And then there's a brief period where they hiked. Technically, the federal funds rate was slightly above official CPI, but that was, one, it's relying on the accuracy of CPI, and two, that was a very brief period. But for the most part, they've been below the inflation rate, and of course, that really accelerated, kind of post-COVID stimulus.